Okay, it is 6:30 my time, and I'm going to go ahead and get started. Welcome to everyone that came in tonight. I appreciate it. You're coming in from different places and different seasons in life. Some people are coming in because they want to hear about retirement planning. Some are looking for pre-retirement planning. Some are coming in because of maybe a job change or a shift in your season, health status possibly, or something like that. Others are just looking for investment ideas, and maybe they have concerns about the current investment portfolio or whatever the case may be. We're going to kind of cover a lot of those same topics tonight, and we'll do it in about 40 minutes if I can get through it all in 40 minutes. So I'll get started right now. So with further ado, let's get going here. We have top 2024 lessons learned that can cost many people up to 30% of their nest egg at retirement, and then the ways to protect it for yourself. So top lessons. Let's take a look. So first off, I'm Mark Stoker. I'm your host, your speaker. I'm a fiduciary financial advisor with 33 years of experience. I do have some gray hair up here. I've been helping clients in pre-retirement and retirement for quite a long time, hundreds, maybe 1,000 at this point. I'm going to call this my 400th presentation, but anyway, we work on a national basis. So we serve clients nationwide. I'm a registered investment advisor, RIA. And so you have to start out as a licensed Series 7, 6, 65, and 63 stockbroker at some point in your career. And then you give all that up and you work on a fee basis. So I work on a fee basis as an investment advisor. I use Schwab as my custodian for my clients' accounts. I'm also a life insurance general agent, so I work across multiple states and multiple contracts across the major top companies with regard to the insurance side of our planning and life insurance and annuities as one component, but investment management and securities on the other. And we do tax planning as well as some other things we'll get into. So we are a member of the Better Business Bureau. Also, you can look us up on FINRA. We'll get to that in a second. National Ethics Association. And we are independent fiduciaries, which means we have to work in your best interest first by law. And so we work with, again, Brookstone Capital Management, and they are a firm out of Chicago and manage about $8 billion. And we use them right now as our active management portfolio managers, and we co-manage with them. And we'll talk more about some of their portfolios in a second, but please do this. Take a pen and write down my website, onthemarkmoney.com, onthemarkmoney.com, and we'll go to that here in a second. We want to give you an idea of what our big three goals are for all of our clients. We specialize in these three goals. Number one, we want to find a way to reduce your fees by at least 40% over your lifetime. And that can be thousands of dollars back to you compounded. So 40% in fees. How do we do that? We'll get into that. Number two, we want to grow and protect your retirement income throughout your lifetime. And I mean retirement income. I don't mean I can take income out of my portfolio. I mean the kind of income you want to make sure it's going to be there forever. Like a Social Security check, you hope it never changes and only goes up, right? And so throughout your lifetime, you want to have that base foundational income. And we plan for that. In addition to that, we also want to find a way to reduce your fees. But third goal, we want to find a way to double or triple your portfolio at the right risk size, not up here, but maybe right here, and make it elevate your lifestyle and have a comfortable retirement lifestyle, not a get-by retirement lifestyle. So that's the three goals that we do focus on. So if you were to look me up, and I have three companies. I have Stoker Financials, the investment firm. Stoker Insurance Agency is the insurance side of the equation. And On the Mark Money is our planning company, and that's our brand name. And so you want to look up Stoker Financial in BrokerCheck, go to brokercheck.com. That's FINRA's website. You can plug in my company name, Stoker Financial Inc., or you can plug in our CRD number 119796. And that'll take you to this page right here that shows that we've been doing what we are structured at right now as a corporation since 2002. So that's a little while. So no complaints. Everything's fine. We're members of the Better Business Bureau as well, A+ rating. If you go to On the Mark Money on the Google side of things, go to Google, you'll find we have some 5-star reviews there. And so if you feel like you like the presentation tonight, please go give us your comments on Google, and we would appreciate that. You can look me up on LinkedIn there often, and we also have access to a National Ethics Association. We're also a member of that as well. So on the screen there, you see a page, a couple pictures there. My mother Marlene on the left-hand side with my daughter Alexis, and then an older picture of a younger version of me with my daughter, my mother, and then my grandmother, who happens to be in that picture. She's 100, I said. So she lived to be 103, so we have longevity in our family. Why do I show you this picture? Well, like many people, my mother on the left-hand side there, Marlene, she worked in HR. She worked in different fields for 50 years, but her last position was HR manager at Ford Motor Credit. And right before she hit age 70, can you imagine what Ford did in their wisdom? Well, like a lot of companies today, last week, et cetera, they laid her off 2 months before her 70th birthday. And that was right before a pension increase. And this was a recurring theme with Ford. And actually, they got sued because of that same recurring example. And so anyway, this kind of caught her by surprise. And so it's one of those things where I bring this up because we try to plan around the pitfalls, and you need to have a Sherpa guide to figure out what those pitfalls are these days. But you can't see that coming. It's hard to plan around. And in that picture, actually, you see my daughter there. She just got laid off 3 months ago at a company she's been, working with for a couple of years. And so it's not an uncommon theme, right? And so we want to find a way to plan around things like that. Make sure that, if you're going to go through the rest of your life money in retirement, it'd be great to have that extra bump in pension income to create the foundation. But if you don't have that, how can you create that? So we talk about those things tonight. And so when you go to my website, you'll see this website right here. You see On the Mark Money, and you'll see this video. There's a video, 1.2 minute video that talks about the same thing. And simply, when we do have our first meeting, it's just not a discovery call. It's a conversation, Zoom call. We work nationwide. And so we want to find out more about you. You want to find more about us. And then we want to find out if there's a fit. We do something in our first meeting, which I'll touch on, is called, I like to call it financial optometry. We look at some simple questions to kind of find out and get a read on what your risk tolerance is and what you're comfortable with overall. And then we develop a plan around that. So the second meeting that we have, if we were to go to a second meeting, we keep our threshold very low. Because we're fiduciaries and we want to have a fiduciary relationship with all of our clients, we keep that hurdle very low. We only charge $1 to become a client, and it's a money back guarantee. So the dollar's not so important to me. I donate that at the end of the month to charity. The idea is we want to make you a client before we can give you advice, and that's legit. And so we keep it very simple. So when we have our second meeting, it's a 2 meeting out of a 4 meeting process. You'll know more about the first and second meeting if you feel like you have value and want to work with us in the future. 80% of the people that talk to us work with us and find a value in what we offer. So again, we talk about these big 3 goals to elevate your retirement lifestyle. So with that, first question out of the gate, most people say, well, hey, Mark, what are your fees? Well, if you go to onthemarkmoney.com, right there in the bottom of the page on the tab that says Sitemap, you can click on that and it'll take you to our investment advisor fee schedule right on the website. So if you think about fees out there today, there's a large discrepancy between top to bottom. I would say that our fee schedule is very competitive to all the competition out there. Like on that first line, $250,000 to $750,000, the fee would be 0.5%. That's equivalent to a lot of robo advisors out there and passive mutual funds. When we're talking about active management and you're using an investment advisor, usually you'll see your fee at 1%, 1.25% at that level. If you have $1 million under management somewhere else, Fidelity, LPL, Schwab, whoever it might be, Chase, one of the banks. You're looking at something between 1.25% down to maybe 0.75, and we are at 0.4. So I've done this for a reason. We're very confident that we can help our clients achieve the goals they're trying to achieve and we're trying to achieve. And I'm willing to give it back and pay it forward. And I know that we work virtually, so we have an advantage in that respect. And so that's the reason we are very competitive in that regard, because we are confident in what we can do. So with that, we also want to talk about a couple things. There's a lot of advisors out there that are either land in one camp or the other. They might say they're all 100% investments. They don't believe in insurance. Then we have the other camp that says they're all insurance and they don't do investments. Honestly, we do a blend because we think it needs to be a balanced approach. So we use managed growth portfolios as well as protected growth income portfolios. And I say managed growth portfolios, I'll get into that in a second. We also use a fixed index annuity, a short-term 5-year fixed index annuity for the bond slice, because we don't like clients losing money in a income buffer approach. And so we'll talk more about that too. So to kind of give you an idea, we create plans, and here's just a quick, simple estimator that we use to identify, some of the angles on what we're trying to do for income. And we want to have both sides met. And so how do we do that? Well, for example, one of Brookstone's stable growth portfolios that we use is their growth basket, and it's had a return last year of 35%. Okay, so the market was up last year. Everyone remembers 2022 when it was negative. So it went down 19.47% in the stock market, and then came back up 22.5% last year. Well, this did 35% because we don't use a broad index. We use individual stocks to drive that growth. And we also use algorithms and active management. So there's a reason why we do what we do, to drive the growth to a better yield, and not necessarily at the same risk tolerance either. So on top of that, we use other things like structured notes that are offered specifically and exclusively through Brookstone. They've got relationships with the major investment banks, JP Morgan, Morgan Stanley, Goldman Sachs, Bank of America, Chase, whoever that might need to be. But these structured notes come in on a monthly basis and have for quite a long time now. They might pay an income of 9 to 12%, depending on the month. And I'm waiting for this month's issues to show up. And so I put clients in these, and I rotate in and out of those instead of T-bills. T-bills are paying 5 and I think 3/8 on a 3-month T-bill. So we could, we're seeing effectively a double that kind of a number. Now, it's not the same risk category. It's between stocks and bonds, but we want to have a blend. And so the idea is to have a balanced approach. And the last component would be a fixed indexed annuity, a short-term fixed indexed annuity with no fees, no frills, but very good returns. I don't know if you can see that, but it's averaged over the last 10 and 20 years, over 10% net returns per year. So that's just I thought, it's a slice of the pie, not the whole pie. And we use that as a component. And so when we take a look at all the things, we start with the first meeting. We don't know what your situation is. We want to find out what your risk tolerance is and what your goals are and what your concerns are. And that's the idea. And so how do we do that? Well, we have a thing called nitrogen or Riskalyze, and we simply ask these questions. Like I said, financial optometry, which one looks better, right or left? And we kind of go down this question and answer path. And 15 questions later, we've got the answer. And so maybe Joe Rodriguez had a speed limit of 35, and so he's comfortable driving around the curves at 35 with his $1 million. Maybe you're at 85, maybe you're at 75. I don't know. We'll find out. I mean, some people are surprised, and maybe they're super conservative and they maybe need to take more risk. And so that also is the case, I see often, because a little, you've been burned a few times, you got a little whiplash, maybe that's the same situation. But we want to find out what your risk score is first, and then we turn around and we get a snapshot of your portfolio, whatever the holdings are. And we don't need personal information, things like that. We can black all that out. What we need is basically just the holdings, a dollar amount and an item. If it's a stock or an index or an ETF or a fund or whatever the case may be, we want to list those things and the values. We plug all that into our software, and then we turn around and say, hey, how did that risk score that you took as your assessment compare to your actual portfolio? Are you up or down or somewhere close? And then we assess that, and we come back and say, how can we improve that for you? Is there a way for us to improve that? And so maybe we reallocate. The idea at the end here is, though, we want to find a way to, number one, again, go back to lowering your fees by 40%. We want to make sure that we can protect your retirement income throughout your lifetime. and whatever that time frame looks like. Could be 103. We don't know. And the idea is also we want to find a way to double or triple your portfolio in regard to all those things. And so if we can take your risk score from a 67 to a 44, like in this case, this client, we bring you down on the risk tolerance side of things, so you're not taking on undue risk when markets do shift. So we could have another 2023 or 2013 that goes straight up, or we could have a 2008, a 2022, or something like that happen again. Quite possible. We might have an interest rate increase. We might have an interest rate decrease. We're going to talk about that in a second too. But all these things change. We have deflation. We have inflation. We have an economic change. We have an election year. So a lot going on. And we want to go back and try to do these basic 3 goals. And so with that, let's get started with why we think we have at least 3 reasons why you might want to change your strategy in 2024. Why average returns could cost you money, and also the danger of a market downturn in retirement. And then, why retirees with a guaranteed income are actually happier and live longer. And then we'll go into some other things. But who is this presentation for? Well, ideally, clients that have $500,000 in investable assets or more will benefit most from our presentation. Some with less, but mostly these folks that have $500,000 or more. People that are looking for a safe place to save and accumulate money tax-free. Also, people that maybe have sold a large asset or a business, or they've inherited some assets and they want to handle it and deal with some of the changes that might be happening, like maybe an inherited IRA. Or also people that are 5 or 10 years away from retirement or already in retirement. So any of those people are exactly what this presentation is for. And so if you stay till the end, you'll receive our free consultation offer, which has a $497 value. And we'll walk through, like I said, walk through your investments, your assets, your concerns, devise a strategy to get you the income and have it protected throughout your retirement lifetime. And then, let's talk about these 3 reasons. So the first one is inflation. U.S. inflation hit a 40-year high. And if you didn't know, all you had to do was go to the grocery store, buy some gas, look at your insurance bills. Oh my gosh. The healthcare cost off the charts. And so, I don't know, I almost make myself sound too old by going in to get a pharmacy prescription, because it's like, I thought those things were $8. Now it's $188, literally, at the pharmacy yesterday. So these things are all going up. And so part of that is the fact that inflation rises, so does the cost of goods. And that goes along with interest rates and shipping and everything else that goes with energy. And so all these things are going to take an effect on a fixed income in retirement. And so it is a concern if you haven't planned for this. Now think about the other equation here is the Fed has raised interest rates, and maybe they'll cut them, maybe they'll raise them. They said, a couple days ago that they were going to cut rates, and then they took it off the table and said, no, we're not going to cut in March. and now they've gone from, basically 1% to 2% to 5% in a couple, 2 or 3 years. You could go to the bank 3 years ago and barely get a 1.5% CD or a T-bill. Now a T-bill is 5.38% on 3 months, but a 10-year treasury is 4%, which is backwards because it's an inverted yield curve, which spells recession, but they don't want to admit that. So it's like, okay, what's going on with the interest rates? And so as interest rates rise, guess what? Mortgage rates rise, housing rates rise, everything, borrowing cost rises, everything rises. And so it's one of those things where we would love to have a cut. We would love to have 5, 6, 7 cuts. Is that realistic? Well, I don't know. I mean, I do remember, I'm going back to my grandmother example. I remember when I was in high school, my grandmother had a CD at the bank that was paying 16.9%. And I remember you could go to the bank and get a CD, put $100,000 into a CD, have the interest pay for your house. So, I mean, these things are historically still there. And one of the other things that is a concern is that the head of the largest hedge fund out there, Ray Dalio, makes an alarming prediction. He thinks we're going to have a stock market correction sometime soon. And I got to admit, I don't think it's too far off. Here's a chart of the S&P 500 today on a weekly chart. We are at a overbought situation. Several indicators on this chart show we have an overbought situation. It's a weekly chart. Could be weeks, could be months. We don't know. But it has It has a top right there. And so we will have a correction. We don't know how much is going to come off. Could be 5%, could be 10%. We just don't know. Things to plan around. And so those are things you want to be concerned about, because maybe Ray Dalio knows more than I do. I would bet so, if he manages billions and billions of dollars. So I got a feeling that may be the case. So I would say that'd be a huge issue. Now, why do average returns cost you money? Why is the phrase average returns, and why could that be costing you money? So many large financial firms brag about their average returns on their mutual funds or their performance reports. And, I've got returns here I talk about too, as far as that goes. But the idea is some of these could be deceptive numbers. And what do I mean by that? Well, let's take an example. So here you have, let's say, a $2 million portfolio. And let's just say, for example, that you've got, if the market goes down, again, example, 50% in 1 year, now you have $1 million portfolio. Okay, big hit, big hurt. But let's back this up again and say, well, what if it went up 50%? It went up 50%. And now your portfolio is worth $1.5 million. Okay, but it's not back to break even. Yeah, that would have to be 100%. But we're at, so the average return, where are we on the average return? Well, you had a negative 50 plus a 50 equals zero. A zero average return. So this is the concern when you're thinking about average returns. You have $2 million turned into $1.5 million. You just burned $500,000 in the equation, but 25% of your principal is off the table. But the returns look good on paper, right? So that's averages. Now, averages aren't necessarily enough. In retirement, you need guarantees. And that's true. We do talk about guarantees. And Kiplinger had an article that talked about retirees with guaranteed income are actually happier and live longer, because they're not worried about things when they have a fixed income coming in or a source of fixed income coming in, like a pension or a Social Security check, because they know they've got their bases covered and they can go, do other things and feel comfortable about life and not be too stressed about the ups and downs that could happen if you're just drawing from a portfolio. So here's another reason why you need a guaranteed income. The danger of a market downturn in retirement. Like I just mentioned, we have the possibility of a downturn. But here's a thing called sequence of returns risk. You probably have seen this. Maybe you have, maybe you haven't. The idea is there's two charts on this right-hand side. You have the left column and the right column. Let's say we talk about the left column first. So you have this series of returns. I know some people are numbers people, some people aren't. I get that. I'll just kind of give you the red and the green on this. So the first column, the left-hand side, starts out in the red for 3 years, okay? And then we have a growth for 4 or 5 years. Then we have a sprinkling in of red. And then we have a little back end on the very bottom. We have green. Okay, so that was that side. Now let's go to the right side. This portfolio, again, green for the first 3 years. We have gains, and then some sprinkled in losses. And then again, same scenario. Down at the very bottom, we have losses for the last 3 years. Now, both of these columns have the same return average of 8%. Both have the same value on the portfolio at the very bottom of $684,848 because there are no withdrawals. Okay, so the important thing here is that all we did, we took these returns and we flipped them in sequence. Doesn't matter when you don't have withdrawals, they both come out the same way. Now, when we don't have that scenario happening with withdrawals, let's say in retirement, so let's say we start out at age 66 on the same equation and we have these returns flipped, but we're drawing down 5% on top of that per year for an income stream, then it gets dicey, because we have that first left side, we have that first 3 years of red losses, and you're drawing down a double dip for 3 years. This is like 2000, 2002, 2003, 2001, 2, and 3. You had that window of time where we had losses out of the gate. If you retired in the year 2000 or 1999, right in there, you'd have been underwater for a while, and it might have taken you a long time to come back to break even. And so this is the concern you have, because that may not look like a big deal, but it is. When you get to 81, 82, you're out of money. You don't know how it happened. And this is the exact reason why. It's just a simple drawdown, but you're taking a double dip. And we want to find a way to buffer this with a way of planning. And so this is why we want to use a balanced approach. And so the idea is, if you have $1 million portfolio and you have 15% negative return and you're down to $850,000, and then you also take out a $55,000 draw for income, you're down to $795,000. You've got to have a 25.8% return to get back to break even, and then turn around and take another $55,000 out. So actually more than 25%. So this is a problem that some people can't overcome if they get hit for a couple 2 years in the beginning stages of retirement. So we want to find a way to buffer that with planning, and we used a balanced approach for that reason. We want to have a buffering account to drive income if you need income right away. How do we do that? And so here are two people that didn't let market downturns affect their retirement plans. One is Babe Ruth. He had guaranteed income annuities. Okay. The other is Shaquille O'Neal. Even though he was a pro basketball player and made $300 million, he still bought guaranteed income annuities for that reason, protecting income. Not necessarily growth or other investments, just the income side of things. And so there is a reason for that. So buffering that and protecting that. So it's not just about guaranteed income. One of the strategies I use for my clients, like I mentioned, allows them to participate in stock market gains with no market losses. And if the market goes up, they participate. If the market goes down, they go sideways or they go up. That's a fixed index annuity, and we use those as a slice of the pie. The other side of the coin is you don't have to avoid stock market altogether. You can do it with protection and profit at the same time, so it's balanced. So we go back to the fact that we use a balanced growth portfolio mixed in with a protected growth portfolio for income as well as protected income. And here's our first offer. So if I'm going to go ahead and send that out to you right now. 1 second here. So we have our offer tonight is our consultation. Right there we go. Our consultation is, let's see if it's something in the there we go. Yeah. Our consultation is exactly that. We want to give you a 30-minute Zoom call, and we talk about the same complimentary session. You can do it on your own, of course, if you want to. But the idea is if you want to know what the math says and the reasons around what we do and the strategies that we use and what other intelligent investors are doing to avoid taxes, fees, lack of control, and unnecessary losses, then you take us up on our offer. It's no pressure, no fee, obviously. And then the idea is it's going to make sense if you're trying to build wealth, protect your assets, be educated about the newest changes. We're going to talk about more of those changes here in a second, and anything that would negatively affect your retirement. We want to avoid that, and we want to give you a comfortable retirement lifestyle. Otherwise, you can do the other things, which will basically punish you for having money. So we don't want that. So click the button and book a meeting. You'll see my calendar link pop up, and we will be having a little limited space there because we have some other meetings coming in the future. So time is now. So next up is required minimum distributions for 2024. What is that? How does it affect you? So with RMDs, or required minimum distributions, the biggest questions that baby boomers have are these. Number one, how do I calculate my RMDs? Okay. And then how do I gauge the taxes on my RMDs? And then can I even save any money on taxes? Is that even possible? And then on top of that, what are the rules for beneficiary designations different than those of other accounts? And so if you have a inherited IRA, what are the rules there? How does that affect you? And so what if my allocations are set in incorrectly, or is there a better way for your RMDs to be allocated? So here's the tax table for 2024, and you can see that the top tax bracket is 37%. Now, that seems like a lot. Seems like a lot to me. It seems like a lot to a lot of people, but actually, historically, if you can see this chart, I know it's small print, right dead center in the middle, you can see in the 1950s to the 1960s, our tax rates were as high as 92%. And so you're going like 92%, that's a lot. So I remember, I think in an interview, I think Ronald Reagan mentioned that one time when he was an actor, he only did 2 movies a year because his income was so high after I think he hit $1 million. His tax bracket was 90%, so he just went back to the ranch and kept on working on the ranch until the next year. So it's one of those things where could we get to a 90% tax bracket again, or a 30, 38%, 45%, 50%, like we've had many times before? Yeah, it just takes Congress to make a change, right? So it's problematic. And so we have required multiple distributions, more like in tongue-in-cheek versus require minimum distributions. We want to take out as many distributions as possible to get the tax bill off the table. What do I mean by that? Well, the government wants you to save money for retirement, but they also want their cut too. And it's like a deal with the devil. This is a tax time bomb. The IRS has created the IRA, and it wasn't for your benefit. It was for theirs. And so RMDs must be withdrawn or you get penalized. Now, the good news is the penalty has gone down from 50% to 25%, but they still penalize you. And so it got to be a little crazy around 2020 when COVID hit. We had a pause on RMDs, and then we had an increase. We had a restart on RMDs, and then they changed the rule midstream in 1 year, and everyone got confused. And so they came out with the Secure Act 2.0. And here's what the latest rules are. RMD penalties will be decreased to 25% if you don't take the RMD in the year you're supposed to take it. They might give you a waive on the penalty if you took it by a few weeks later, whatever the case is. I've seen some of that too. But the point is, that's the 25% penalty right now, not a 50% penalty. Roth accounts and employer retirement plans will no longer be required in 2024. Beginning immediately, you can also do an in-plan annuity payment that might exceed a participant's RMD amount, and the excess to be applied to an RMD in the following year. But if you're turning 72 this year and you have to take your RMD, you have until December 31st of 2024, or you can delay it until April 1st of the following year, which would be April 1st of 2025. But you have to take not only one distribution, but two in 2025 if you turn 73 in this year. Before next year, and then the following year, you have to take your regular distribution also. So a double withdrawal. Now, how do you calculate your RMDs? Well, here's the uniform lifetime table, and you take that first year up there, 26.5, and that's age 73, the first year you have to take distributions. Now, if you just do simple calculations on your own, take your account value on your IRA from December 31st of the last year, so 2023, and then you take that assumed life expectancy number, that 26.5, divide it from $100,000, let's say on the IRA example here, and you'd have $3,773.58. Now, if you had $1 million IRA, add a zero, it'd be a much bigger number. So that's the problem. You're required to take it out. You're required to pay the tax. And so these don't necessarily decrease. They go up with age. And so that's the problem. And it's like a tax time bomb, like I said. So, and on top of that, if you ever wanted to leave an inheritance to someone, you don't want to do it with a taxable bill at the end. It's not really a gift. It's more like a penalty. So, I mean, they're gonna have to pay the tax in a 10-year window now with the newest rules. So, not understanding how RMDs work with 401ks. And so, let's say you are 72 years old and you have $1 million in 401k savings. So, let's say you have IRAs. You have $500,000 in total IRAs. You might have two accounts, one for $250 and another for $250. You can take your total RMD, your required minimum distribution for that whole entire amount, $13,250, from one account or both accounts individually. It's your call. If you have 401ks though, whether it's 401ks, 403bs, 457s, they must have distributions taken from each account individually. And so you can't commingle, you can't do a combination, and that's the rule. There's no firewall between the two. You have to do them separately. So again, RMDs that have to be taken separately can be 401ks, 457s, or 403bs. Those that you can do together could be the IRAs. And if you're talking about how does taxation work on RMDs, well, it comes out taxable as ordinary income. There's no capital gains tax. Okay. So with that, what's up next? We have Roth IRA changes. And so Roth IRAs for 2024. What is a Roth IRA? Well, you have your IRA, you have your individual retirement account, and that's designed to supplement income in retirement. And it's available to anyone that's over 59 and a half without a penalty. If you do it before 59 and a half, you have a 10% penalty. But there's a combination between traditional IRAs and Roth IRAs. And so what is the difference? How does that work? So traditional IRAs, you're talking about the government created these, and they said, okay, we'll give you a tax deduction if you make this deposit, and you can do it tax deferred, and you'll eventually have to pay tax on it. The problem is you're taking and letting it grow, and the tax bill is getting bigger and bigger and bigger and bigger, and that's the problem. And so until you pay that tax, it'll always be an IRA, right? And so it's always going to be an IRA until you make it a non-IRA, either by withdrawals or by conversion. Now, tax timeline. Tax on the Roth IRA, a tax break later, is what Congress came up with this, but they made it so complicated and difficult, you hardly can get one. So you have to make withdrawals. You can make withdrawals after 59 and a half. You do it before, you're going to have a penalty. But the idea is this could all change in 2026 with some new rules. But there are income limits on who can do a Roth IRA. Number one, if you're married and you have income under $218,000, you can do a Roth IRA contribution. If you make more than that, it's either reduced or eliminated altogether. If you're single and you make more than $138,000, reduced or unavailable. So it's like it's minimal on the opportunity for a Roth contribution. Now, can you do conversions? Well, that's what we also focus on. So maximizing your Roth IRA, can you do a conversion? Well, we look at, obviously, here's the tax brackets again. So we have that 38% tax, 37% tax bracket. Required minimum distributions must be taken out by 73. And then if you do that, it creates income tax at that time, which could cause a ripple effect on your provisional income. And you may or may not know that or like that or want that, but you're forced to take it. So why do a conversion? Well, the IRA is going to go to a Roth. All you have to do is pay the tax on the transaction in that year that you convert to the Roth. Then it grows tax deferred and comes out tax free when you take it out. So moving forward, doing this wrong can increase healthcare costs, can increase tax on your marginal income tax rate. And on top of that, it can actually increase capital gains taxation. So then the other thing they took away was recharacterization. So you say, hey, I'm thinking about doing a Roth. I did a Roth. Now you've done a Roth. Maybe you thought, I'd like to reverse that. No recharacterization, no reversals. So it's once and done. You can't, no give backs. And so unfortunately, there's no way to fix that if you've already done one. So you've got it. Now, what we do also is tax planning, not preparation, tax planning. So we look for, and this is ideal for small business owners. This is ideal for high net worth individuals, ideal for large IRA accounts, because we want to find out how we can lower your tax bill, how we can effectively do a Roth conversion for you. If there's a way, and a way to do it, we have the software tool to do it. And so we identify these tax savings opportunities for you by simple process. And it's fairly painless for you. So we can do this pretty quickly. And we navigate to find out, hey, is there a way to get to the best tax position without hitting that next hurdle? And that's what we're trying to do. We're trying to be efficient about your tax exposure year over year. And so a lot of our older clients longtime clients, I should say, have done this, whether they're young or old, doesn't matter. It's about income. And the idea is if you've got Roth potential there to do a Roth conversion, great. If you have self-employed businesses and you're trying to look for some deductions, things like that, we can find that as well. So that's what we do as well besides investment planning. So options you have number one, you can do it all yourself. And the option number two is you can take us up on our complimentary strategy session, which is just a 30-minute Zoom call, and we walk through everything. And then we're going to give you the math, the reasons, the strategies to find a way to identify savings in your fees, savings in your taxes, efficient way to grow your portfolio, as well as lower the risk score and guarantee a retirement income stream throughout your lifetime, and hopefully 2x and 3x your portfolio. So all those things are what we do. And with that, it's ideal for people that want to build wealth, protect assets. If you've got more than $500,000 in assets, highly recommend you speak with us, because you just never know what you might uncover. I find new things every day. I talk to people, and we are never surprised. we never find a day we haven't found something new that's different. And I hope 80% success rate on who we talk to. So I hope we can help you. With that, click the button, book a call with us. No cost on the consultation, no cost on the second meeting. We've waived that too. And we would like to work with as many people as we can, and we hope we can talk to you soon. All right. And 30 minutes, see what the difference could be for you. Okay. So with that, we're going to wrap up. I appreciate your time tonight, and I know you're all coming from different places. I thank you for spending with us. And I think I got it inside. What is it? I think it's exactly 39 minutes. Wow. Okay, that's good. Hope you guys have a great night. Thank you very much.